The Great Depression did not begin with panic. It began with a promise. 7 months before the crash of 1929, the most powerful banker in America reassured the market. His name was Charles E. Mitchell, nicknamed Sunshine Charlie, president of National City Bank, the largest commercial bank in the United States. The ideal modern banking executive. He promised liquidity. He promised stability. He promised there would be no unnecessary crisis. "I still see nothing to worry about," Mitchell told reporters on Black Thursday, October 24, 1929, after the market had already begun to collapse. By the time fear appeared on Wall Street, the outcome was already embedded in the structure of the system. Senator Carter Glass would later say, "Mitchell, more than any 50 men, is responsible for this stock crash." The world before the fall. The 1920s were defined by acceleration. Mass production transformed industry. Consumer credit reshaped purchasing. The Dow increased sixfold, from 63 in August 1921 to 381 in September 1929. Growth felt permanent. Economist Irving Fisher proclaimed, "Stock prices have reached what looks like a permanently high plateau." For the first time, ordinary Americans became investors. Charles Mitchell made this possible. In 1916, National City Bank hired Mitchell to head its investment affiliate. Under his leadership, the bank opened branches nationwide, transforming banking into an accessible industry. Salesmen sold millions of shares totaling $650 million. By 1929, National City operated 100 branches in 23 countries. Mitchell became a celebrity. His 6-story mansion employed 16 live-in staff. Expansion of access. Stocks became accessible and aspirational. The song of the day, "Blue skies, nothing but blue skies." Mitchell's daughter recalled, "People believed everything was going to be great always." But access alone doesn't create instability. Leverage does. The mechanism margin. Stocks were increasingly purchased on margin, a practice Mitchell and National City popularized among ordinary investors. Here's how it worked. Investors put down a fraction of a stock's price, often just 10% equity, and borrowed the rest. 90% debt. In rising markets, this magnifies gains. A 10% stock price increase on a 90% leveraged position yields a 100% return on invested capital. But in falling markets, it accelerates liquidation. When stock prices drop, lenders issue margin calls, demands for additional collateral. Investors who can't pay are forced to sell. Forced selling drives prices lower. Lower prices trigger more margin calls. More margin calls force more selling. The mechanism becomes self-reinforcing. By 1929, margin debt had reached unprecedented levels. Speculation wasn't confined to the wealthy. It had spread to the middle class, fueled by banks like National City that made credit readily available. Structural risk. The crash was not primarily psychological. It was structural. When many investors are leveraged simultaneously, selling becomes mechanical. Individual fear doesn't matter. The system liquidates itself. Charles Kindleberger, the economic historian, would later note that in 1929, there was no lender of last resort effectively present, no institution capable of halting the cascade. Federal Reserve warning. Economic data softened in early 1929. Steel production declined. Construction slowed. Automobile sales dropped. Consumer debt climbed. Yet stock prices continued rising, detached from economic fundamentals. The Federal Reserve grew concerned about speculation. On March 25, 1929, after the Fed issued warnings about excessive speculation, a small crash occurred. Investors started selling rapidly. The market's shaky foundation was exposed. Stocks plummeted. Call money rates, the interest charged on margin loans, spiked to 20%. Restraint seemed possible. The bubble appeared to be deflating in an orderly manner. Then Charles Mitchell intervened. The public reassurance. 2 days later, on March 27, 1929, Mitchell made his move. He announced that National City Bank would provide $25 million in credit to stop the market's slide. Mitchell, who served as both president of the nation's largest bank and a director of the Federal Reserve Bank of New York, effectively defied the Federal Reserve Board's admonitions to stop making speculative loans. He told the press that his bank would loan the funds rather than permit a complete demoralization of the money market. It worked. Confidence returned. Call money rates declined from 20% to 8%. Prices recovered. Participation increased. Risk was not removed. It was deferred. Mitchell had demonstrated that the Fed's traditional instruments of financial control were ineffective. The message to speculators was clear. The bankers would bail them out. Final euphoria. Through summer 1929, markets reached historic highs. Leverage ratios were extreme. Debt-financed asset purchases at unprecedented levels. The structural flaw was simple. When debt finances asset purchases, price declines trigger automatic margin calls, forced liquidation, and credit contraction. The system was primed for collapse. All it needed was a spark. October, the domino effect. In early October, institutional investors quietly reduced exposure. Smart money was leaving. Prices softened. Small declines triggered the first wave of margin calls. On October 23rd, an unexpected decline began about an hour before trading ended, a 4.6% drop in total market value. Investors panicked overnight and resolved to sell at the opening bell. October 24th, Black Thursday. The market lost 11% of its value at opening. In the first 3 minutes, nearly 3 million shares traded hands. The ticker tape couldn't keep up. It ran hours behind, leaving investors blind to actual prices. Mitchell rushed to the House of Morgan, where he joined J.P. Morgan Jr., Thomas Lamont, and Albert Wiggin in a desperate stock-buying spree to restore confidence. It worked, briefly. The market stabilized by day's end. October 28th, Black Monday. The Dow declined nearly 13%. October 29th, Black Tuesday. Some 16.4 million shares traded, a record. The collapse was complete. Within weeks, billions in wealth evaporated. Aftermath. Banks failed by the thousands. In 1930, 1,352 banks holding more than $853 million in deposits collapsed. In 1931, 2,294 banks failed with nearly $1.7 billion in deposits. Credit contracted. Businesses closed. 28,285 failures in 1931 alone, a daily rate of 133. Unemployment surged. The Great Depression lasted a decade. Charles Mitchell? He survived, initially. National City Bank struggled but didn't fold. Mitchell made it through a congressional hearing in 1932. He was even planning a trip to Italy to consult for Benito Mussolini. Then came the subpoena. On February 21, 1933, Mitchell testified before the Senate Banking Committee in what became known as the Pecora investigation, named after Chief Counsel Ferdinand Pecora. Under Pecora's relentless questioning, Mitchell admitted to practices that destroyed his reputation, selling his National City stock to his wife at a loss to avoid paying taxes, later buying it back, receiving massive bonuses while the bank's stock plummeted, issuing misleading securities to unsuspecting investors. The press called him a villain. Time magazine wrote, Mitchell had been a thoroughly wicked banker. He was arrested for tax evasion in 1933 and tried. Though acquitted of criminal charges, the government won a $1 million civil settlement. He resigned as president of National City Bank, the position he'd held since 1921. But Mitchell didn't go to prison. By 1935, he was working for another financial firm, slowly rebuilding his fortune. He died in 1955, largely forgotten. Financial systems respond to structure, not intention. Charles Mitchell didn't cause the Great Depression alone, but his actions, expanding access without managing leverage, defying the Federal Reserve's warnings, prioritizing market confidence over financial stability, embedded structural fragility into the system.